Hello and welcome to our YouTube channel Nonfiction Summary. Today we are going to have a look at the bestseller book The Psychology of Money by Morgan Housel. Enjoy the video and don't forget to leave a like and tell us your opinion about the topic in the comments section. Each person has a unique perspective on the economy and money. The Great Depression's history is well recognized. A decade of consistent decline for the world economy followed the terrible 1929 stock market crash. Everybody experiences the economy and money differently, according to the book's first major takeaway. When John F. Kennedy ran for president in 1960, questions regarding the Great Depression were raised. Several voters were shocked by his response. He said that the Kennedys were already well off in 1929. And throughout the ensuing 10 years, their fortune did not disappear, rather, it increased. The family had more staff and a larger home by 1939 than it had at the beginning of the decade. Only after enrolling at Harvard and reading about the Great Depression did he grasp the devastation that many of his fellow countrymen had endured. It came out that not all Americans had been in the same situation. Kennedy sought to alter that, which was one of the ways he persuaded voters that he wasn't simply an elitist out of touch but also a deserving president. But we all experience economic life differently. It's not only the rich and the poor. For instance, a wealthy person who experienced periods of high inflation while growing up will regard money differently than a person of comparable wealth who has only ever encountered stable pricing. What we do with money is shaped by the lessons that emerge from these various viewpoints. We all like to assume that we understand how the world operates, but the reality is usually much more nuanced than that. We know less than we'd like to think we do. And that is the first thing to comprehend when it comes to the psychology of money. Financial decisions are driven by personal experience. When modeling financial behavior, economists frequently rely on a convenient fiction, irrational people who act in their own best interests by maximizing their returns. Of course, reality is a little messier than this simple concept. Think about something like the lottery. The average low-income household in the U.S. spends $411 a year on lottery tickets. At the same time, 40% of all households struggle to come up with $400 in a pinch. Unsurprisingly, the same low-income households who spend slightly over $400 on lottery tickets make up this 40% of the population. Is this conduct reasonable? Hardly, yet it's also not illogical. Living paycheck to paycheck makes it unlikely that you will have enough money for even necessities, let alone luxury like vacations. Playing the lottery is a long shot, but it's better than the alternative, which is having no chance of obtaining the nice things that people with more money take for granted. Unreasonable phone calls of this nature happen more frequently than you may imagine. For instance, investors were highly reluctant to make bond investments later in life if inflation was strong between their late teens and early 20s. Conversely, if inflation was low throughout these formative years, investors were content to keep investing in bonds as they grew older, regardless of whether inflation increased along the way. With stocks, a similar trend applies. Investors continued to invest in the stock market if it was performing well in their early adult years, but they avoided it if it was underperforming. Importantly, judgments to invest or not didn't change even when the market did, indicating that empirical evidence did not influence early life instincts. Our current understanding of economics is still a historical infancy. Why do so many of us handle money in such a poor way? One response is that, in the big scope of things, it is relatively new. Only about 600 BC saw the introduction of the first kind of money, and those ideas pale in comparison to more advanced economic theories. Take a break. Most Americans worked until the time of their death prior to the Second World War. Of course, life expectancy was lower back then, but even so, in the 1940s, half of all males over the age of 65 were still actively employed. After World War II, Social Security was implemented, and things began to change. Yet, for the majority of American workers, retirement remained a distant dream until the 1980s, when the average monthly Social Security check increased to over $1,000 after adjusting for inflation. Only a wealthy minority could afford to retire in their mid-60s prior to that. Hence, one of the most fundamental economic ideas that we employ today is less than 2 generations old. The primary retirement funding mechanism, the 401, didn't even exist until 1978. And the Roth-era retirement plan wasn't even created until 1998. Other important principles and methods aren't much older. Index funds are barely 50 years old, but hedge funds didn't truly take off until a quarter of a century ago. Even consumer debt, which is one of the main factors in economic growth in the United States, didn't become widespread until the GI Bill made it simpler for regular Americans to take out loans in 1944. We aren't stupid if we make poor financial plans and decisions. Rather, it's just that we are novices. Contrary to popular belief, luck plays a significant influence in financial success. Luck is a complex subject. We frequently believe it is impolite to credit others' achievements with pure luck. As a result, when it comes to making financial decisions, we frequently end up neglecting the importance of luck. That is incorrect. The wealth of two siblings is more closely associated than either height or weight, according to economist Bhaskar Mazumdar. To put it another way, if your brother is wealthy and tall, you are more likely to be wealthy than tall. This association can be explained quite simply. It's conceivable that siblings from the same home will have access to the same opportunities and privileges. Parents that enroll one child in a reputable school typically also enroll his brother. Yet if you find two wealthy brothers, you'll find two people who don't think Mazumdar's research pertains to their family. That has to do with how people think. Usually, we either overestimate or undervalue the impact of luck on results. If we succeed, it is because of our diligence. If we fail, it is due to bad luck. Nevertheless, we aren't nearly as forgiving if others fail. In certain circumstances, we don't blame failure on bad luck but rather on character faults like indolence or blinkeredness. Unfortunately, our success-obsessed culture isn't much of a help in this regard. Brilliant investors who lost everything because they were unlucky and the market suddenly tanked aren't celebrated by Forbes. Nonetheless, it does honor poor or careless investors who struck it rich by luck. That puts us in a bind. We need a means to incorporate randomness into our models when it comes to money in addition to determining what works and what doesn't. Shiller's wish to account for the precise function of chance may be beyond our ability, but as we'll see, we may still understand luck. Making better decisions can be aided by concentrating on broad trends as opposed to particular occurrences. Success is a terrible teacher, as Bill Gates famously remarked. According to Gates, success deceives intelligent people into ignoring the significance of luck, leading them to believe they are impervious to loss. In a paradoxical manner, doing that almost guarantees that you will lose. So how can you include luck and chance into your financial behavior? So, here's what you shouldn't do. Fixate on the instances of certain people. When we research highly successful people, we frequently choose outliers, billionaires who have altered how the world functions, and this might mislead us. Once more, making better decisions might be aided by concentrating on broad trends as opposed to particular occurrences. Consider John D. Rockefeller, one of the most prosperous businessmen ever. He ran into an issue when he was developing his petroleum industry. He was unable to carry out his plan since it was against American law. His simple approach was to ignore them. He actually showed such a complete disdain for legal precedent that one court remarked that his company acted no better than an ordinary robber. The success of Rockefeller influences how we view this conduct. Looking back, it's simple to praise his vision and point out that he steadfastly resisted allowing antiquated restrictions to stifle progress. Would we still believe that Rockefeller's example is one we should follow if he had failed? Most likely not. At most, we would perceive him as a failed criminal who showed us what not to do. But when it comes down to it, luck is what makes the difference between these two outcomes. It's possible that a few different judgments here and there or a shift in the political landscape might have changed Rockefeller's fortunes. More importantly, it's virtually impossible to replicate good fortune. You can't guarantee the dice will fall the same way for you as they did for Warren Buffett, even if you follow his every career move. The alternative is to continue looking at patterns of success and failure. The more prevalent a pattern, the more probable it is to apply to your financial and personal choices. For instance, study after study demonstrates that people who have control over the schedule of their days are more content with their jobs than those who don't, in contrast to the rare instances of extreme outliers. That is a general observation you may use straight away. You can become careless out of envy. Wealth creation and envy are two things that capitalism excels at. Consider a baseball rookie who earns $500,000 annually. He is wealthy by any fair measure. Nevertheless, if he shares a team with a superstar like Mike Trout, who earns $36 million annually, he might find himself dissatisfied with his salary. He wants what others possess. Trout and other wealthy earners contrast their incomes with those of others. For instance, you needed to have made at least $340 million in order to be listed among the top 10 hedge fund managers in America in 2018. By that measure, even Trout is a toad. In the context of capitalism, jealousy is morally acceptable. But there is an issue in practice. Jealousy causes terrible decisions. And those decisions cost a lot more than the profits you stand to receive from them. Consider it this way. If your desire is insatiable, you will eat until you become ill. Yet, you don't do it because throwing up is far worse than any meal is good. Not taking advantage of opportunities doesn't necessarily mean you're missing out. Rather, it's a knowledge that attempting to eat everything up will make you regret it later. It's simpler to accumulate wealth than to maintain it. Jesse Livermore was one of the best stock market traders in early 20th century America. He contributed to the creation of Wall Street. He was worth $100 million in today's money by the time he was 30. Livermore made the best choice of his career just before the 1929 stock market crash when he took a short position and wagered that equities would fall. The market did indeed lose a third of its value. Livermore went home to his family with good news. His fortunes were liquidated and reports of insolvent investors jumping from office windows spread. He had just made the equivalent of $3 billion in today's money. Happy endings? Not exactly. Recall how we stated that success makes a bad teacher. Well, Livermore believed he was untouchable after his significant victory in 1929. He kept placing more and bigger wagers and losing huge, until his fortune was gone. In a Manhattan club in 1940. He committed suicide because he was broke and in debt. It turns out that sometimes being wealthy is much easier than maintaining wealth. It is understandable why those who excel in the former frequently struggle with the latter. Risk, hope, and bravery are the three key ingredients of making money. A whole new psychological game is played when keeping money. It has to do with the worry that everything you've accomplished might go. Remaining wealthy also requires modesty. After 1929, Livermore believed he was a genius who was impervious to error. He'd have been better off accepting that luck had played its part, and that his success couldn't be duplicated endlessly. There are many Livermores in the world, but their tales are typically not as tragic. Over time, the value of about 40% of all publicly traded corporations decreases completely. In addition, barring situations of death and intra-family transfers, the Forbes 400 list of America's wealthiest people experiences a turnover rate of 20% every 10 years. How then do you maintain what you now have? In a word, tenacity. The most successful business people maintain their success for a considerable amount of time. A tiny element called dread is what unites them all. When you're afraid of losing, you view possible wins through a different prism, according to multi-billionaire venture capitalist Michael Moritz. Few advantages are significant enough to warrant taking the chance of losing everything you have, and you're much more likely to make wiser decisions when you adopt that perspective. You can make a fortune even if you are half right. Heinz Berggruen didn't appear to be a particularly promising young man, according to his own perspective. He was unsure of his future plans when he was compelled to leave Nazi Germany in 1936. He worked as a journalist with a side job in art criticism after majoring in literature at the University of California, Berkeley. For $100 he purchased a tiny watercolor by Paul Klee in 1940. It was the start of a lifelong fascination for contemporary art. By the 1990s, Berggruen had established himself as one of the greatest art collectors ever. He paid the German government 100 million euros for his collection in 2000. That was nowhere near its true value, which was estimated to exceed $1 billion and included a considerable number of Picassos, Klees, Matisses, and Braques. It was among the most significant collections ever assembled. How did Berggruen assemble this astounding collection of the finest painters of the 20th century? Or was it just pure luck? A more intriguing response comes from the investing firm Horizon Research. All outstanding collectors, according to the company's research, purchase a sizable amount of artwork. Some purchases out to be excellent investments, particularly if the collector keeps them for a long period. But the vast majority are failures. The key, according to the Horizon Research, is to hold on to the former until the portfolio return, or the worth of the entire collection, converges upon the return of the best pieces in the portfolio. Berggren's collection resembled an index fund somewhat in that his risks were equally distributed over a variety of investment. He bought everything he could get his hands on rather than just items he happened to like or admire and waited until a few winners appeared. This approach can be used for all investments. The propensity for a small number of events to account for the bulk of outcomes is known as the long tail. This concept is supported by a great deal of challenging mathematics. But when you get right to the core, it's rather straightforward. Fundamentally, you can afford to get more things wrong when you get a few things well. Failure is a given. What matters most are the characteristics of your achievements. To put it another way, you don't have to worry about your collection's other 99 duds when you're sitting on one Picasso. Summary: real-world financial decision-making is far messier than it is in textbooks on economics. Many decisions, such as purchasing lottery tickets when you're broke, are irrational, yet they are nevertheless reasonable in their own right. The same is true for investing decisions, which are frequently influenced more by people's early adult experiences with the economy than by sober assessments of the state of the market. Simply put, psychological considerations are intertwined with financial decisions. What's the best course of action then? Hence, be prepared for luck to play a part in your success. Develop a fear of losing what you already have, and spread your bets. Thanks for watching the video. When you made it this far, don't forget to subscribe to the channel, write a comment, and activate the notification bell to support us. See you next time.